Hello and welcome to this webinar on investment baskets which are apt for the current scenarios. My name is Deepak Jasani and I will take you through this short webinar explaining the various, some few of the baskets that HDFC Securities has been offering to the customers. Now, HDFC Securities has started offering basket investing from mid of 2018. Currently, we offer about 35 baskets, which are based on various themes like smart beta, long-term, sector trackers, insurance and AMC packs, groups, low-risk smart beta, quant models, etc., etc. So, on various themes, we are offering about 35 different baskets. Now, what are the advantage of baskets? Now, these are typically baskets of stocks which are selected and weighted intelligently to reflect a particular theme or a strategy or an idea. Now, in case of a basket, the tracking of the performance of the basket is very easy. SIP investment is also possible. You can do rupee cost averaging, long-term goal alignment by way of SIP investing. Diversification benefits are also available through basket investing, although we don't believe in too much of diversification. You can invest and rebalance in a single click. There is flexibility to exit fully or partially at any point of time. There are no expense ratios except the brokerage and depository charges which are applicable. Unlike those in mutual funds, which charge anywhere between 1 to 2.5% annually on the investments that they manage, and the stocks and ETF which you invest, they directly come into your demat account, so you can track them. You can have that sense of ownership over the stocks and ETF, unlike in mutual funds where there is co-ownership and you don't, you just get units allotted to you, rather than the shares or the ETFs allotted. Now, today we will talk about 4 baskets. 2 of them are existing baskets and the balance 2 are freshly or newly launched baskets. Now, the existing baskets, both of them are investing in ETFs. They are theoretically or indirectly they are basket of baskets, because ETF themselves invest in a number of stocks. Now, it is a low-cost way of investing. If you do a basket investment in ETF, there is no fund manager bias involved. So basically, the investment by the ETF manager has to be done as per the benchmark which is followed. So he cannot sort of change the stocks unless the benchmark stocks are changed. He cannot change the weights of the stocks unless that is done by the underlying index. So now let us first talk about the Platinum ETF. Now this Platinum ETF was launched on 21st of May 2019. This has exposure to the top 125 to 150 stocks listed in India. This is a fully equity exposure basket. This ETF invests in 3 different ETFs. The one is Junior B's, 50% weight is allocated there, 25% is allocated toward Nifty, and 25% towards Bank Nifty ETF. So between the 3 of them, 100% investment is made. Now, there are no changes since inception in the composition or the weights so far. 1 lakh invested in this ETF at the launch date will currently be valued at about 75,349. In case you are invested in Nifty also, that would be about 75,320. Now, what is unique in this is that despite a mid-cap bias, because there is a mid-cap bias involved here, because 50% weight is allocated towards the Junior Bs. Despite the mid-cap bias, it has outperformed the small cap and mid-cap indices by a good margin. For example, between the launch date and today, the small cap index is down about 42%, the mid cap index is down about 30%, whereas this particular ETF is down less than 25%. So This ETF or this basket is suitable for people who want exposure to the top 200, top 125 to 50 and 150 stocks, and who want to remain fully invested in equities. Now, the next existing basket we'll go to is all-weather investing. Now, this basket was launched on 22nd of August 2018. The objective of this was to diversify with equity, gold, and fixed income ETFs for recession-proof investing. So this basket invests in three asset classes as equity, debt, and gold. The portfolio is rebalanced periodically to generate relatively higher returns with least possible risks. Now here again, the weights have changed over time. For example, at the inception, Nifty weight was 24.2%, which has now gone down to 16.8% as of 31st of March. The junior B's Nifty weight was 13.7% at the original inception, which has now risen to 17.6. So basically, when it is seen that the mid caps have become more attractive, or as from valuation perspective, the weight in the mid cap or the junior B's has gone up. Gold B's weight has remained more or less static. 40.3 has as of now remained at 40%. In the interim, it has gone down, but now it has again come back, partly because of the rise in the value of gold. Liquid B's. Now, liquid B's, the original weight was 21.8%, which is currently at 25.5%. So now this basket has clearly outperformed vis-a-vis the Nifty 100. Now, this is clear from the chart which is displayed on the screen. The orange line is the Nifty 100 index, and the blue line is the all-weather investing NAV. So there is a massive outperformance vis-a-vis the Nifty 100. So for investors who had invested in this basket, their value would be 1,06,562 versus 1 lakh invested on the date of inception, which is August 2018. And this is despite the fact that Nifty in the meanwhile has fallen about 24.5%. And small cap has fallen by about 51.5%. So for protecting your corpus or for protecting your investment, these baskets are of much help. Now we'll go to the two new baskets which have been launched recently. The first one we'll talk about is Fallen Angels. Now, Fallen Angels, the basket of Fallen Angels basically consists of hand-picked quality stocks that have fallen massively in the current scenario, which is compounded by the coronavirus pandemic, but will recoup very fast once the market recovers. These stocks typically bounce quite sharply once the risk-on sentiment returns to the market. In the interim they face temporary setbacks, and this is why we think there is an opportunity to buy them, to accumulate them whenever the prices are at a low level. Now, having said that, it is a volatile basket. Individual stocks may not have yet made a bottom. Some of them may still go lower. So that is why this is meant for risk-bearing investors only, who are willing to take higher risk, expecting a higher return out of that. So now investors can again invest in these either by a lump sum investment or by a SIP investment over the next 8 to 10 months. There is the potential to generate a return of 15 to 18% per annum based on SIP investing. Of course, the risks here are higher than in other stocks. There is a table, and the weights of each stock is being given in the report, which is available on the website and which is also shown on the screen. Now, minimum investment in this basket is about 12,200 rupees, and the individual weights vary between 7.7% to 15.7%. Now, let us go through the stocks which we have listed in this basket. There is Bandhan Bank. Now, most of these stocks are well known. They have a lot of positives. We will talk only about the reasons why they seem to have fallen, and that is why there is an opportunity to acquire them or to sort of accumulate them at attractive prices. Now, Bandhan Bank. Now, there is a stress currently on the microfinance book. There is a risk of elevated NPAs, and because it is highly present in Assam and Northeast, because of the recent disturbances there, the possibility of slippages have increased. Now, all these 10 stocks have proven management quality or trustworthy management quality, and that is why they have been included here. The next stock is Cummins. Now, Cummins, there is a lot of dependency on diesel, which is slowly going out of favor. There is also dependency on auto sector, which is currently quite weak. Export markets are also dull, and the capital goods sector within India is also not performing for the time being. And that is why these stocks are available at much below the recent highs. But their pedigree, the management pedigree, is impeccable. The third stock is HPCL. Now, HPCL there is a risk of demand for its products getting impacted due to this coronavirus pandemic and the lockdown. There is also the risk of oil price volatility and the gross refining margin volatility. They are currently quite soft, and that is why they may see some setback in their refining margins. Of course, their marketing margins will continue to be good whenever the movement of vehicles come back into India. There is also the risk of being owned by PSU by government. So the decisions taken by the promoter may not be always in favor of the minority investor. The next stock is Hero Motocorp. Now here again, the stock has undergone a lot of pain, mainly due to BS6 transition. The cost of ownership has gone up due to that, and also due to higher insurance costs. There are inventory issues which are being faced by the company, and of course there is this rural slowdown, where there is a lot of dependency of this company on the rural areas. So now, once the rural area sees a turnaround, once we see monsoons settling down well enough, then this stock could come back in favor. The next stock is Hindustan Zinc. Now again, this stock is the metal stock is getting impacted due to the economic slowdown. The metal prices have fallen quite sharply. There could be delays in the project execution. But having said that, it has a lot of assets in terms of mines, and it is India's largest and world's second largest zinc-lead miner with more than 50 years of operational history. Currently, Vedanta Group and Government of India are co-owners. Whenever government stake is will be bought over by Vedanta, the stock price could see a revival. Plus, whenever economy turns upwards, this stock could come back into favor. Next stock is Indecision Bank. Now, Indecision Bank, there are a lot of concerns about asset quality lately. There could be exposure to stressed groups, and there have been withdrawal of deposits. So these are stock is a lot into negative news currently, and that is why it has been falling. It has fallen quite sharply from the recent highs, almost 70% from the recent highs, and that is why there is an opportunity to bottom fish in this stock. The next stock is Infosys. Infosys there are issues about SEC investigation, class action lawsuit, and the bigger concern is the spending cutback by big clients because of the global economic slowdown. So due to these reasons, the stock price is underperformed, but the management, the structure of the company, the digitalization of the company in terms of services, all this means that whenever things come back to normal, this Infosys will be one of the best companies to benefit out of it. Next is ITC. ITC basically in the recent budget, there was an increase in the duty on cigarettes. FMCG, there has been a slowdown in spending, especially for ITC. It has been a little more acute. The volume growth in the FMCG segment has also been a bit soft over the last few quarters. And the hotel business has been impacted due to this coronavirus pandemic. So again, there it could get hit because of low occupancy and low room rents. But this is all temporary phase, I think, and the company is one of the best dividend-paying companies, well managed, and the current downfall gives an opportunity to accumulate these stocks at these levels. Next is Ntpc. Now here the risks are the slowdown in the power consumption. Regulatory risk always remains because what kind of returns this company will earn will depend on the regulator, the power regulator, and coal availability is another risk. So basically, the demand for the thermal power is sort of plateauing because the renewable energy output is increasing. However, this situation will continue as long as the power demand is subdued. Once power demand resumes to its original trajectory, I think Ntpc also will do quite well. And the last one is Petronet LNG. Now here the risk include demand slowdown generally due to economy slowdown. Ramp up risk at Kochi. Now it has set up a new terminal at Kochi a few years back. But the ramp up of volume is happening quite slowly because of other reasons. And crude price fall. If the crude prices continue to fall, then probably the attractiveness of gas versus crude oil will come down, and that may lead to underutilization of its capacity. So these were the risks of all these 10 companies. The positives of these companies are well known and are listed in the report which has been put on the website. Now we will go to the next new basket which has been launched, which is defensive stocks. Now this basket of defensive stocks is a basket of well-managed businesses with strong customer franchisee that are fundamentally stable. So these companies include companies which are fundamentally strong with a lot of customer franchise and which are fundamentally very stable. There is not much volatility in their performance or even in their stock price in downturns especially. Now the minimum investment here is about 33,400 rupees, and the weights and the names are given in the table on the report. The weights are between 7.7 to 14.9% in each of the 10 stocks. Now, these stocks carry the benefit of long-term gains with lower risk. The risks are lower than the other stocks in the universe. They tend to do well in downturns. Here also, one can do lump sum investment or SIP investment over the next 8 to 10 months. And there is a potential to generate about 12 to 15% per annum return with lower risks through SIP investing. One can take advantage of the fall in stock prices due to the current pandemic related risks and the sell-offs, and do bargain hunting, because these stocks typically are highly valued and they would not be available cheaply. So whenever they are available cheap due to these reasons, there is an opportunity to do bargain hunting in them. The basket has adequate diversification across industries. Basically, we have banks, we have insurance companies, we have auto companies, we have software, we have pharma, we have hospitals, etc., paint companies, and such like. Now, let us go again stock by stock. The first one which we have chosen is Apollo Hospital. So again, here the positives are quite well known. We will only talk about why they have fallen recently and why it makes sense to look at them to buy, because the reasons for their fall may not last long, and they may be transitory or temporary reasons. Now, Apollo Hospital, what are the risks or concerns which has led to the fall? Basically, their inability to increase margins. Now, if they are not able to increase their margins despite having such a large base, then if they enter into debt-funded capex or acquisitions, then that could again lead to some issues. There is a promoter pledge in the company that in the past it has led to some derating, but promoters have taken steps to reduce that pledge over time and have promised to bring it down further. The other risk is that currently the hospitals are seeing low occupancy uh, due to this pandemic. The other elective surgeries and procedures have been postponed by government directions. So only this pandemic related treatment has to be given across hospitals, and even the patients and their relatives are not keen to undergo elective surgeries at this point of time. So those are the few risks as far as Apollo Hospitals is concerned. The next stock is Asian Paints. Here, the volatility in the crude price, because a lot of his raw materials are crude oil derivatives. Then entry of new players or entry of or addition of capacity by competitors is another risk, and forex exposure is the third risk which the company faces. Apart from general real estate slowdown or economic slowdown, which is applicable to most of the companies. The next is Dr. Reddy's. Now, Reddy's the risks are basically delay in resolution of FDA issues, delay in approvals, getting approvals from the regulators, then adverse outcome of litigation and regulatory challenges. Now, these are a few of the risks that the company faces. Currently, pharma stocks seem to be back in favor over the last few days because of the pandemic and also because of the consistent underperformance of the sector over the last 3 or 4 years. Now we are seeing some sort of a revival of interest in the sector. But these risks which I mentioned are still applicable. But the positives are also there for everyone to see and everyone to look at and act upon. The next stock is Hindustan Unilever. Now here the risks are basically rural demand continues to be weak. Dependence on rural spending is quite large for the company. Recovery in the rural as well as urban economy is uncertain at this point of time. Government has been talking about spending a lot of money to stir consumption demand. Now we will have to see as to how far they are successful and how soon that happens. Competition and raw material price volatility are some other risks that the company faces. The next is ICICI Bank. Now here the biggest risk is economic slowdown, which results into slow credit offtake growth and also results into slippages in asset quality. So these are the main risks which the bank is facing at this point of time. The next stock is Maruti Suzuki. Now here the risks include consumer spending slowdown and economic slowdown. Mainly both are interrelated in a sense. Subdued passenger vehicle demand. So there are various reasons for the subdued passenger vehicle demand, including the cost of ownership, including the ride sharing cabs which are available, the parking issues that most of people are facing and such like. Then there is also a risk of price increase, which the companies have to take due to BS6 issues. They also have to offer a lot of discounts to clear their inventory. There is also a risk of rising input costs. Otherwise, the positives are all mentioned in the report for Maruti Suzuki. Next stock is Pidilite. Now here the few of the concerns which are being faced are economic slowdown, due to which the renovation or new furniture making will get postponed. Then subdued real estate and auto demand is the next concern. and competition from local and international players is the third concern that is being faced. The next stock is Power Grid. Now here the risk include delay in capitalization of assets, regulatory risk, of course, because how much the company will earn depends a lot on the regulatory dictates, and power consumption slowdown and weak SEB finances. So because there is a slowdown in power consumption, about 9%, March power consumption for now was 9% lower, but because we went into a lockdown post 24th. But if you take the full month, then probably we could see in a normalized lockdown scenario about 25-27% fall in power demand. So that could lead to fall in revenues for the company. And weak SEB finances. So basically, if the SEBs, state electricity boards finances are not do not improve, then their offtake of power will come down, which will again hurt this company. Next stock is SBI Life. Here, lower than expected growth in the premium income, lower than low protection business, and low margins and rising competition. These are the four main risks which SBI Life faces. Of course, life insurance business has a lot of scope in a country like India. Some time back, the valuation of the insurance company had also expanded to slightly beyond the near term, but now they have come to reasonable levels, which are worth considering. The last stock in this basket is TCS. Now here again, similar to Infosys, the risk include dependence on BFSI and global spending cutback by their customers, and forex volatility is another risk that the company faces. So these were the this was a discussion on the stocks in the two recent baskets as also the two old baskets. I hope this talk was useful to you. Here's wishing you happy low cost investing through HDFC Securities. Invest in idea baskets. Thank you.